What we're hoping is that this goes absolutely viral, and then Spencer feels really bad about himself.
Ooh, that's the goal here.
So share this with your friends.
And so it's got a lot of people asking a lot of questions about how do we do that better and maybe separate ourselves from just being a pure, strictly service business to being somebody who can actually alter the returns on the investment. That's one of the great things about being a property manager. You got tons of vendors, you got tons of technicians. They all have great abilities, different lead times, what they're good at and what.
You get this short runway with kind of owners to like earn their trust, but as soon as you do one dumb thing, then it's I don't trust anything.
And one of the exciting things about becoming a more measured business and metrics driven is because even if you lost in the conventional ways, like, oh, I got that angry call, you still look and be like, man, we're holding a great resident sat. Man, our speed's exceptional. Still nailing it.
All right, everybody. Welcome back to the Evernest Property Management Show. As you can tell, the children have taken over the studio. Spencer is out today. I'm sure he's, at the old folks' home doing something. Maybe they had an early dinner, and so it was. It's 4 o'clock. It's after 4 o'clock here, and I'm sure Spencer's somewhere eating dinner. But we're gonna have a good time without him. As you can tell, we have probably one of the most famous vendors in all of our space here. He came to Birmingham to spend some time talking maintenance with us. So I want to welcome to kick it off, Ray Hespen with Property Meld.
Well, thank you so much. I also was a little bummed Spencer wasn't here. I thought I was going to get a chat with, but this is, I guess this will be.
I always tell everybody when I go to conferences, that's the first question I get asked is, where's Spencer?
He's a rock star at these things.
And of course, I've also got my co-host today, Gray Hall.
2 days in a row.
2 days in a row. That's right. We're taking over for Spencer. So what we're hoping is that this goes absolutely viral. And then Spencer feels really bad about himself.
Ooh,
that's the goal here.
So share this with your friends. No, we were here talking about maintenance. I was telling Ray when we kicked off our conversation, I was like, there's two areas where you, as a property manager, you can't invest enough money. And I know that made you feel good because one of those is your section. One of them I would say is leasing.
Yeah.
Anything we can do to lease it faster, and really it's kind of what we call cash to cash. It's like when somebody moves out of a house till somebody moves in, how quickly can you get the house re-rented? But the other piece of that is repairs and maintenance. So really excited today to talk about repairs and maintenance with you.
Well, and I don't think it's always been the case that those two things were the most important. I think, we were talking about, on 2021, nobody cared. Right? We don't care how we're executing in maintenance. We don't care about our costs because rent is out punting it so hard. Our lease times were non-existent because people were renting properties sight unseen and putting cash deposits down. And so if you fast forward now, what is 3 years, it is almost completely flipped. The dynamic and power shifts have happened to where the renters have a lot of power. We're still getting increased rents if we're renewing, but now rents are compressing. And so those two things that you listed are very much because of the macro environment that we're all in. But yeah, I do like this problem.
Yeah, and I just got off a call with an institutional client, and they're not buying houses right now. And that's going on across the whole ecosystem of our space. And that they're turning internally and saying, how can we optimize what we're doing? Yeah. And so we're having a lot of these conversations right now. Yeah. And as people know, Property Meld is one of the top maintenance softwares in the industry. It's been, I guess you've had a relationship with Appfolio, been in their stack for over a year now. And how's that going?
Well, as time flies.
Yeah.
I think it's actually been close to 3 years now.
Oh, wow. Okay.
One year sounds
time flies when you're having fun. We were one of their first four. Phenomenal partner. And I think they responded to the customers really well of just, we need to connect here. But yeah, it's been going really well. And I think what's interesting about, the different partnerships we have, accounting systems, is everybody's being pressure tested to think a little bit differently about the future. And I think a lot of it's happening because the macro pressure that's on property managers now. if you think about, you and I have talked about, and Gray, we got a chance to talk about it today, is around this concept of like NOI. I think there was an element where our industry really felt like we're just a service business. And if I do more work, I get paid more. And that's great. But I think now, as we realize how much harder NOI is to deliver investors, how can we get a little bit more aligned on that and alter actually that outcome and that number and take some ownership on that? And so it's got a lot of people asking a lot of questions about how do we do that better and maybe separate ourselves from just being a pure, strictly service business to being somebody who can actually alter the returns on the investment you've made on your properties.
I've actually had some institutions and bigger owners come to us and say, how can we align the property manager's incentives directly with us? Because as the owner, my incentive is to make as much profit as possible. And you as the property manager, how do I make your incentive to make as much profit as possible? How do I get the essentially align incentives around NOI?
Because they often feel misaligned, where if you get a percentage of rents or percentage of maintenance or a percentage of all of this, it's like, hey, we win and you lose. And that's not always the case, but it's tough to like fully align incentives because we're doing work and we have to kind of get paid for that. And you've got a business that you've got to run. But I think managing for some of these institutions, like they think about NOI differently than retail investors do. And so I think the shift is thinking about that, how you drive more, because I think we've got more control today than we probably previously had.
And I think I've got this stupid 1991 Mustang. This has been a ton of fun to work on. I've always wanted to work on a car, and so I'm getting mine, and I'm going through YouTube University. And anyways, there's some body work that has to be done. I'm not going to learn. But one of the things that's interesting, so I dropped my car off. I was so impressed with this place. This is my second time back, and I'm getting an Uber driver to take me back to the office. And I get the Uber driver, and I said, hey, if you ever need body work, these people. And it was so funny, the skepticism she had. Well, last person really screwed me and yada, yada, yada. And like, it was such an interesting visceral reaction. And I was thinking about how much trust is reliant or is a prerequisite for parallel industries that we think about that are not aligned with us. So for example, you think about auto, mechanic or whatever, like everybody knows a guy. And the reason that's so important is because they're high integrity. They're going to do the right thing. But they're misaligned on incentives. If I work more on your car, I get paid more and you lose more. Same thing with a doctor. A doctor makes more money if they work on you more, not less. And so it's really interesting. We've had to solve for those problems through high trust-based systems. But I think there's an element where we can see some models where maybe even financial advisors or, people that like in the profession of recruiting only pay if they place. It's like, we're both going to win or we're both going to lose here, right? And so how can we align those more so it's not such a heavy skepticism, trust-based business and more like we both win, right? Or we both lose.
And so when you think about repairs and maintenance and turn costs, what are some ways you're seeing some of your customers improve NOI for their clients?
Well, one of the big things that I think everybody knew, but unless you can put it in bean counter language or put it in an Excel spreadsheet, it's kind of ethereal, was this idea that renters leave because of poor maintenance. I think Kingsley did a study years ago outside of just needing to because of your job or rent was too high. The number one operational thing that was controlled when they were doing exit surveys with renters was maintenance. But it's still like, yeah, but, right? And what we ended up doing is, as we had like an investor retention analysis against maintenance, there was like one interesting thing that really stuck out to us. And it was around this idea if residents are happier, then investors stay around. And so as we've talked about, we're to the point now where we can statistically prove a certain maintenance operation style starts to alter the renewal rate. And the reason that's super, super important, and I realize maybe those who are watching this are not as excited as I am, if you can save one, it's $5,000. Like it is worth so much money to that investor. And if you can statistically alter that to the benefit, it's very significant. I mean, you're talking about a 10, 15, 20% bump on returns if you can alter it. And if that's operationally in control, by a property manager, it really changed the game of being able to change those alignments and incentives. So I think a lot of us are taking this new information and going, how can I deploy it and get my teams to operationalize, helping alter renewal rates for my investor because I want them to win too.
I think more importantly, even for like retail doors, even over institutions, getting people to stay in houses, what we've found is that the retail owner would prefer to even take a discount on the rent just to keep somebody in that house. And what we've also found is if you can just keep that resident 1 year, 18 months longer, there's a decision point when the resident moves out.
Yeah.
That owner decides, hey, am I going to sell this thing? Is this going to be a churned unit in our system? And so anything we can do to make that resident stay longer is just going to prolong that decision and prolong that capital continuing to come in from that owner.
It's just a really big punch you in the mouth decision point as an investor, right? And you've got that in your monthly statement. When you pull your monthly statement out as an investor, best case scenario, it is rent minus management fees. And you sit there and know it's like the credit card that you don't have to some extent, and you open it up and it's like, those are all decision points. But the one that's a big one is when the renter's leaving and you get the news that, hey, they're not wanting to renew. And it's like, okay, again, in the macro economy of increasing rent, that's awesome. This could be great news. 8% increase coming your way. Right now, it's not great news.
And it's good for the institutional investor in that period because you generate a return. But the reality is you got to outlay a lot of cash. If the tenant's been there for 4 years, for the retail investor, like their biggest fear is not being able to pay their mortgage.
Right.
And so a 30, 60, 90-day period is extremely painful. What I like about having this data is people have always kind of talked about keep the resident happy. That can mean a bunch of different things.
Yeah.
That can mean amenities. That can mean resident benefit. That can mean all of these things that it's hard to kind of like directly tie.
Yeah.
But like when my heat is out and it's the middle of summer, like I'm going to be super happy if that is fixed quick and fixed really. Like there's very tangible kind of a return.
100%.
So for me, it's like if we can alter renewal rates and keep more residents in there, reduces a lot of work for our teams.
Yeah.
But also it's very actionable.
Yeah.
Now, the question is like, how do you fix that and how do you kind of alter that? But it's at least like, hey, I see a direct return if I can do X, Y, and Z on the maintenance side.
And I think this is going to be quite the renaissance for property management because, too, if you can make a financial case that you can alter this is a very big deal. So there's two components, and you brought up one which I think is great. There's the awareness that you potentially have a resident that's statistically a lease churn risk. The thing that property managers uniquely have immensely great capability of doing is taking action on those things correctly. So you think about the vast network that you guys have. That's one of the great things about being a property manager. You got tons of vendors, you got tons of technicians. They all have great abilities, different lead times, what they're good at and what their costs are. And so you've basically got, I don't know an analogy, but if you think about, chess, when somebody makes a move, you're able to make a variety of moves to do that. And I think that's one of the things that landlords oftentimes don't have, and why I think this will be a big renaissance, is because one, you can have awareness of it using the large data set. That's great. Let's assume that's commoditized. Two, being able to take action. If you've got a lot of different pieces to make a move to alter that outcome, that's going to be where property management really comes through and shines on what sort of resources and actions they can take that just, frankly, a lot of people are managing a small handful of units or even sub 100 units is still going to be relatively limited. And you're just not going to be able to react in a way that can alter that $5,000 lease churn. So that's where I think if we do things correctly and we act correctly, I think this is going to be one of the biggest shifts and drivers that professional property managers are starting to be perceived as the NOI alterers, not because they can just identify it, but because they can take action on it.
And talk about some practical steps in the data now. Like that's kind of like the future state, but there were some very clear things that property managers can do now to improve the chances of resident renewal.
I'll give some quick hit list ones that are some really great indicators. So we had the data set that we looked at when we got the study that we're releasing is over, I think, 110,000 first year residents. And we basically were looking at patterns of which ones renewed and which ones didn't. And we could go very, very deep into data. Everything from what types of repairs they experienced, when did they experience them, how much communication was happening, what the speed was. And it really gives you a sense of it's very much like Moneyball. If you've ever watched the movie Moneyball, it really is a math game. And so I'm going to give you the simplicity, but the chaos of this. In your first 90 days, you can increase the likelihood of a lease churn by over 90%, just based on the amount of repairs that you have in a few key areas, which is crazy because everybody wants faster turnover speeds, but maybe that's the worst idea in the world if you're not going to avoid three things. And basically it's your key systems, your air conditioning, water, and hot water. And so another thing that we ended up finding out is satisfaction is a really big deal. Very well correlates that residents that rate their maintenance experience more poorly have a drastically higher chance to churn the lease. We also found that basically if you have a lot of communication, overly communicative or underly communicative during their tenure the first year, can basically alter the renewal rates. And so we take that data, and I'll talk about our platform specifically. We've started to find ways to flag those behaviors that we're seeing with the resident, because just like anybody, if they make their boss unhappy at work or they tick off a coworker, they're not just going to keep doing the same thing the next day. They're maybe going to come in a little softer next day. Hey, I'm sorry, man, or I'm sorry, And so not only flagging it, but in our platform is being able to actually surface the risk, but also surface which are the best vendors or technicians to send based on their recent performance that would be able to best combat that particular situation. And that's just one way. But
what you mentioned there I think you said you could increase the chance that the tenant moves out by 90% if they have an issue, obviously, with water heaters or HVAC or any of the kind of major systems. What it makes me think about is getting upstream. Okay, when you're going through the turn, part of the challenge we have is, hey, we've got a 15-year-old system, a 12-year-old system here. Okay, what is the data that says the likelihood that this will fail in the next number of years? And then there's the repair versus the replace decision. Oh. It's just such a challenge to talk to an owner about that, especially like a retail owner, and say, hey, I need you to outlay an extra $10,000 here. But if you don't, and if this fails, the tenant is going to move. I mean, it becomes a math problem, but you've got to kind of like have some of the data and to be able to communicate that. I think that's a lot of the benefit that's been missing. And if you've done this a lot, you can communicate that to an owner. But like that's a lot of the like, unlock power, I guess I see in this.
I'll tell you what, you're spot on. And I got to watch this from institutionally owned asset and retail investors. Smart home tech. Like you watch a bifurcation completely of adoption. Smart home technology is like almost completely adopted by institutional. They own the houses and they're sitting there going like, yeah, this makes sense. How much can I save in rekeying costs? How much can I save in this? How much can it prevent a statistical flood or whatever? And then the third party, retail are like, how much is that? Do we need to spend that? And it's because one can tolerate portfolio risk in the statistical element and one cannot. And so I think there's an element where we just have to be really good at showing the numbers. And people believe numbers 10 times more than they do. If I were to sit there and say the same thing, I'd be like, hey, do you know that in the first 90 days, if you have key systems, resident lease churn risk goes up drastically versus it's like 90.8%. It's like, whoa, okay, you got that science, right? So we have to find ways to communicate really well to justify our decision and use data and industry data to back it up. It's almost got to be conditioned somehow. And I don't know how we make that leap. You guys would be a lot better at figuring that out. But that is a big thing that we have to do. If we really want to alter NOI, we have to find a way to take control of those statistical decisions and act on it, even if some of them are a little bit more expensive in the time.
What's helpful from a property manager standpoint is having something, now assuming that everybody kind of believes it, but having something else to point to, like, hey, I'm not the bad guy here. This is what the data says, because this is a trust game. And oftentimes the owner's fear is, hey, they're gouging me for price, so they just want to drive up and make more money. And if you're actually using data to kind of show them, hey, this is why we are recommending this, I think that can be a powerful thing.
Yeah. And I heard somebody say, make data the enemy.
Yeah.
I've heard that with like performance management. Hey, those numbers aren't good. Sorry. But you're spot on. We have customers that use the benchmarking data regularly because people are calibrated in their own heads and you're not in control of that. But what you can do is you can calibrate them and they're not going to believe you, but they might believe, a recent report on how much these are costs, or a property management maintenance platform that has data across however many units. Like it's
I think it'll change the game in a lot of ways, just because I think we've just started collecting a lot more data and we've got data in kind of key parts of our business, but that even on like the leasing side, it's like being able to communicate to an owner, if you drop the price X, I think we will be able to statistically lease it, which translates then directly to NOI. So I think we're starting to kind of like in a couple of these key areas. I think one of the parts that you told me about was, pretty exciting is we get a maintenance request. And if I've got somebody who's been in the seat for 30 days, we have no idea what those water heaters are going to cost. We don't have necessarily price books that, are kind of accurate and reliable. Be able to go ahead and communicate, hey, generally this is kind of the range. Let's go ahead and get like an NTE. I think that's just like, there's just tons of applications if you get this large data set. I think it makes the PM's jobs a lot easier, and it gives them almost like this reference book to kind of refer back to.
Man, and I'm going to not say I stole the idea from you. I'll say that I was strongly influenced. I really loved the idea of how do you make a 60-day maintenance coordinator be like a 20-year. And I think one of the challenges is property management is such a hard business. Our turnover is high because it's an inherently negative business, right? There is no winning. There's how much not losing did I have today, which is like super unfortunate. I think that's been one of the exciting things about becoming a more measured business and metrics driven is because even if you lost in the conventional ways, like, I got that angry call, you still look and be like, man, we're holding a great resident sat. Man, our speed's exceptional, still nailing it. Bill hit a new record on how many jobs per day you got done. You can balance the wins from measurable against the negative. Now, that being said, nobody calls maintenance coordinators and says, you know what, I'm just really glad you took care of me. You did it for less cost than I did, and I just want to call you and say thank you.
All our owners call our guys and say that. I don't know what you're seeing.
Yeah, I need to talk to different property managers, I guess. But so the whole thing is, if it's inherently negative and it is high turnover, how do we speed up efficacy, right? And I think that's one of the big things that you're talking about is how can we do that? Because the better we can do that and the faster we can do it more consistently, we can alter NOI. And I think the data stuff that you're talking about is like, is that context? Be like, here's how much that should cost. Does that invoice look right?
Yeah, there's nothing more embarrassing than having a new PM send an invoice or even an estimate to an owner, and it's so far out of line with reality. And you're just like, why did you send that? Well, I didn't know any better.
Yeah.
And so flagging some of that will keep us from losing trust with an owner right off the bat. I will tell you, a lot of our churn comes from property managers leaving. And, one of the great things about LLMs or AI is they really are good at two things. They're great at processing data. So that gets into the how much should something cost relative to everybody else that's fixing that same thing. But it also is great at going and getting historical context, right? Like it's very frustrating to an owner for an air conditioner to break. We send out somebody and they throw a $500 or $600 part on there, and we replace the air conditioner 12 months ago, less than 12 months ago, and there's a warranty on it. And so, who's going to end up eating that? Evernest ends up eating that. And so what a great use case for the future of AI is to help a new property manager make great decisions.
Oh man. Yeah. I think it's a great application.
You don't have to talk about it. We're going to cut this part out, but you don't have to talk about it unless you want to.
No, I do. And I don't think you should cut it out at all.
Okay.
I think you just let it ride.
Then roll.
Well, and I was going to say, I think that's, I was thinking about a conversation as a maintenance coordinator, like two conversations. If we think about like, what does that conversation sound like? Owner calls, I'm pissed off. Why did you do this? And so a lot of times us as property management firms interact by going like, let's put the nicest person to talk to the investor, not the person doing the work, because we need that to happen, right? Because the context is rarely there. So it's got to be like, Bill, I'm so sorry. Or Jane, I'm so sorry. Let me go take a look. Let me go suss some things out. And you got to go run that. That's how a lot of the times we do things. Now, imagine that same conversation today as being like, no, you can talk straight to the maintenance coordinator. It doesn't even need to be the nicest person. It needs to be the person with the context to give the answer. Listen, owner Jane, yeah, I'm super sorry that thing was $500, but I'm going to tell you our data is starting to show that this resident's become a lease churn risk, and you know what that means. It's $5,000 out of your pocket. I'm really trying to do everything I can. So I ended up picking this technician. They're only less than a day out. The resident's going to love them. I know that because they've been to that property before. They're highly rated by that resident, and they're very cost effective. You're going to really like that. So that's how we went ahead and took action on it. You don't have to have the froofy, like the softener.
Let's go. I'll go check it out for you.
We don't have to have that. And so that's the beauty of what that context can bring is can allow people to go directly to the people. We don't have to put these weird buffers in between.
One of the things that we discussed earlier today, which I think is pretty powerful about this too, is it's about setting upfront expectations around what it's going to cost. You know, the frustrating thing about being a client is you don't feel like you have any say-so. Like the repair happens to you, right? Yep. And when you can surface the potential repair amount prior to going out there and get a predetermined or a pre-approval on what that repair is going to be, what we think that repair is, we think it's going to cost this much, and it feels like some element of control is given back to the client.
Yeah, and I try to think about like other examples, like healthcare. I don't think anybody would argue. Well, actually, you know what? I'd say that you guys were working out this morning while I was pumping out work. That's
while
fine.
You were sleeping in?
I wasn't sleeping in, but the whole thing is like in health, like when we go to a doctor, we do feel out of control. There's no, what is done has been done, or what is wrong with me is wrong with me. And we do want to have that sense of control, but we're looking for somebody to give us guidance on what our control should be. And I think that's one of the big differences in property management is when we talk to a doctor, it's like, you know the answer, right? Can you please tell me you've seen this before and all that? And so since we're not there in that sort of trust dynamic, they're completely wanting to control it outside. And I'm not sure if I believe the doctor.
There's a lot of that.
Yeah.
There's a lot of that. You've got this short runway with kind of owners to like earn their trust, but as soon as you do one dumb thing, then it's, I don't trust anything. And the reality, I mean, it's just a tough job.
Yeah.
And if you've got somebody with even 1, 2, 3 years of experience, like there are things that they are not experts in. That's just a challenge in this business. I think data can help them.
Do you, earnest question, do you think it's because we built it and then we did one thing and lost it, or we were never really building it and so then it doesn't take much to lose it?
I think it's the first one. I think you can lose trust from just doing one thing that feels like way out in left field. And I think you can repair that trust, but what you don't want is consistently, even one trust loss, like you send an invoice or an estimate that seems too much to the owner. Now all of a sudden they're going to be watching everything and asking a bunch of questions.
Fair.
But I don't think we play offense enough, and it comes back to like the expectations, because the expectation from the owner is probably rent minus management fee, and that's what I get. So anything south of that is a negative, and I don't feel like we do a good enough job at least setting expectations and playing offense of the value that we're providing.
By the way, you're so right. I have to say something.
You keep saying that to him, yeah.
I know. Well, he's
right.
He's right.
He gave me a script.
Yeah. No, what's crazy is
property Meld talking points.
Yeah, you're so right. No, I was actually thinking about that owner statement, that very nature of what you said. Like the reality is there's a statistical monthly cost coming out, and here's how you're pacing for the year. What if you were to walk in and be like, here's actually the negative downspend you should be on maintenance, and actually here's what you are.
Oh, that would be interesting. What if you?
That's a good thought.
What if you did a budget?
It's almost basically budgeting.
Yeah,
because the owner should be doing that on the back
you
end.
need to. We've looked at thousands of houses just like this, and we think you're going to spend about this much this year, and
amortize it.
Yeah, it's like maybe that's $2,500 or whatever a year. And then you just basically deduct that from that budget.
And then they get a nice little bonus at the end of the year if you
maybe.
Or if
you're
maybe
off
it rolls
budget,
over.
maybe it's a little bit over, but at least you have one frustrated conversation instead of dozens.
And the whole thing is it's getting them to think about that expectation. Through the year, you should statistically spend this, because right there, I forgot. I come back next month and, nothing happened. Oh,
yep.
And it's like, oh, that's bad. And it's like, no, actually, do you realize how good those last 2 months were?
Yeah.
And so I do wonder if like some of those things, and it comes back to what we've talked about is like, how do we keep treating them like investors more? And just giving them pace. Here's where your pace is on these budgets. I know you didn't give us one, but here's what you can expect. Here's your mini P&L that's coming to you every month, and here's how you're doing on pace. And that way they see those as victories. And the moments that you are spending a little bit more on maintenance, it's not all bad. The only bad part is the dollar amount over budget. And so anyways, you guys are more than welcome to take that idea. Let me know how
I mean, it's a
goes.
great idea. I mean, with MFR clients like multifamily or institutional, like they are budgets that you're kind of solving for. It's a little bit of the Wild West. I think part of the benefit is like, as we continue to kind of like use more data, is like bringing institutional level management down to the retail investor. And this is a little bit what we're talking about.
Yeah.
Because if you bought a home and then you move out of the market, like your job is just to keep that mortgage paid, not put a bad tenant in there. But we've seen a lot of them transition into investors. And so I think we can help them in that journey. One thing that we did kind of on the idea of like having a budget is we start having conversations before a resident moves out. They gave notice, hey, we're going to go look at the annual inspection report. We think the estimate is going to be about this much. And we will start withholding rent. And I think one, that solves with kind of like owner debt, but two, that kind of mentally gets them prepared. And so can you do that with R&M and work orders? We're starting to do that. We've seen a lot of positive things in the renovations, but I think there's a lot to that idea.
Yeah, springing something on the owner feels bad to them, but if you're preparing them, then it feels much better. I mean, they still don't like it, but
Yeah, and I think the whole thing is if they feel like it's an investment. Like none of us, well, maybe you guys do, not me. I actually liquidated 401k so I could start Property Meld. But let's assume most people. Let's assume
what's
most people.
a 401k?
Yeah, exactly. I
never had one.
Good for you. Yeah, I never heard of her either. But the whole thing is normally people in the 401k are not checking. I don't look. You don't look. Like I'm guessing. I don't know. Most people don't look. And so the whole thing is like you do want to eventually get to that. Right? Nobody looks at the thing, I've got friends that trade blockchain currency, cryptocurrency. And the whole thing is like every day, every week can wreck those humans. And the reality is if you got a 401k, you're like, net, stock market tends to go up, 5-6% a year. I'm just going to expect it. And I don't have to worry about it until I leave. Yeah. And it's that weird monthly statement that keeps reminding them to some extent. And obviously a lot of retail investors have to pay the mortgage, right? So I'm not trying to disgrace that, but it is trying to get them thinking about net, you're probably going to go up 5 to 6% a year or more. Net, 5 years out, 10 years out, and getting them to think about it that instead of like, the cryptocurrency where they go, man, I made a ton of money today. Oh, I lost my ass.
I mean, even like there's just kind of like the cash flow side of it, but it's like, hey, what is your home value done? Like, what is your debt pay down? Like, what is your total? There's a guy out in Denver who kind of talked about like the 4 quadrants, and there's like obviously cash flow, but there's appreciation, there's NOI growth, and there's debt pay down. You kind of sum all of those up. But part of that is just like positioning, and then your fees became a much smaller percentage of that. Now you can't touch all the equity, but then you start to unlock, how do you unlock and leverage that equity and what's your return on equity? And so you get to this place where it's just, instead of just how much cash is in my bank account and the owner statement, it's kind of painting a longer term. But you've talked a lot about that today.
Well, and I was, I forget where I was going to go with this. You responded to this thing around this concept, but I was talking with another property manager. I remember I was talking with another property manager. Is like you get them as retail investors that are coming in, and a lot of them are accidental. Oh, maybe I left, or maybe this is my first one. It's a huge value asset, and I'm nervous, I'm scared, and so control, all those sorts of things. I said, the whole game, it feels like at that point is how do you get them as quickly as humanly possible to recognize they're actually an investor, not a landlord. And so we were talking about what would be the litmus test in that. And I was sitting there thinking how great it would be if you were a property management company that was so good at informing people what they actually are sitting on, which is incredible retirement, that when they went to a party, how fast could you make them, when people ask what they do, how fast could you get them to say, I'm actually a real estate investor, as the first thing that they say out of their mouth? And the whole thing is, I think a lot of it is expectations, but how can you just keep peppering them what they have, those 4 quadrants? But again, I think a big opportunity, and I think probably a prerequisite to actually delivering NOI, because this comes back to, should we repair or replace that asset? Maybe we spend a little bit more money now to save you turnover over here. And so we've got to somehow get there.
Yeah, I would say having that more educated conversation, empowering the PM to have the educated conversation is the holy grail here. Like, how do we get there, and how fast can we surface that information?
Yeah, and it is that's a great call out, because like if you look at the people that started these businesses, Gray, yourself, you obviously, is you could have a conversation with any investor and deliver that trust very quickly.
Yeah, I was very empathetic because I was an investor.
Yeah, right. And so you can do that all day, but how do you to make that 60-dayer, right? And it's very evident because most people that are running larger property management firms could talk to any investor and have a pragmatic, logical conversation, deliver tons of trust and commitment, and get the investor to go, I see what you're saying. It is the right decision. Let's go do this. And so really, it's 100% capable. And the only thing that is separating that from happening is the fact that they haven't been in your shoes for 20 years and doing what you're doing.
Well, I think about the person that's been managing homes for forever, and they want to go take a month break, but if they leave, then their team doesn't know how to answer those questions, right? It's kind of like you're the brains of the operation. You make all the hard decisions. I mean, this would even be good. Something like this would even be good for a property manager that manages 200 to 400 doors.
Right. 100%.
And it seemed like, well, a lot of this, like on more simple jobs, this seems very kind of doable with like the AI today and like the data sets. But like, how do you think about like the more complex kind of jobs? And so as you get like more expensive, more complex, the data will it be as accurate? Like obviously like water heaters are very easy to kind of compare and like what's market rate for that. But bathroom remodel or kind of certain components of it, like that's where some of the experience comes in of like, there's 15 different strategies, back to the chess piece analogy.
Yeah, and
like,
what does bathroom remodel even mean?
Exactly.
Right?
Yeah. What do we do there?
And I think the whole thing is like the thing that makes, and again, AI is really good at data analysis and I think data decision, they're statistical models by nature. And like one of the things is like not just incorporating that, but it's around the next 5 years of rent. It's about the next 10 years of the assets inside there. It's about the appreciation of the asset. There's a lot of things that are in consideration when you're doing even a rehab to make those decisions about, do you want to think about this as a 2-year plan, 5-year? That was one of the things you were talking about, and being able to be dynamic and ingest all that data and make a recommendation based on what their goals are. I think that was one of the things you were kind of sharing with me. And those are hard. I honestly think, I don't know what's going to come first. Either the data and intelligence to contextualize that is going to come first, or insurance is going to come and just underwrite everything at some point once things get predictable enough that you could just underwrite returns.
That would be interesting.
I mean, there's a world where it gets there where it's an insurance product. That's basically what it is. But this is what you're going to spend, and this is a flat fee for maintenance.
Yeah,
and
an owner would never get
risk on
frustrated if every time they open that statement or that email, if the same amount of money got deposited.
Every single time.
And maybe it's a little less money than they would have gotten otherwise, but there's no peaks and valleys.
And insurance, it can be a low margin business, but it would serve the function that like institutional operators have, the benefit of portfolios and not having one home wreck you. It's you spread the risk among all of it, and you can be able to predict that risk really well. I think it will actually be a great enhancement to our industry. We got to get it tight enough.
Yeah. Do you think it's possible with like just single family homes are just very, you don't kind of understand the condition. Like obviously there's home insurance, but that is for like not maintenance and kind of like repairs. Like I think we will get there maybe like, is that 20 years away?
No, I wouldn't be surprised if in less than 5 years you don't have meaningful products.
Really?
Yeah. And one of the benefits in property management too is being able to be the carriers of those, because insurance providers need like some risk tolerance and like what is the likelihood of it falling outside the statistical thresholds. And so if you're looking at one homeowner and be like, I want you to insure me, insurance is going to be like, sure, we're going to put a whole bunch of basically leeway here to basically make sure that we're covered. But when you do that all over the homes, it's very possible. And my confidence in the 5 years is, one, just, I mean, I know what we're collecting from a data perspective. I know what fails in rental units, and those are actually relatively predictable if you get a large enough data set on it, and we're continuing to grow it.
Does that include like actually going and seeing the type of refrigerator, the type of air conditioner, putting in the code or whatever?
Yeah, so roofs are huge CapEx expense, but they're a massive expense. And obviously outside of emergencies, which again, you can statistically model how many times a pipe bursts. It's not rocket science. But what it's going to come down to is those other things. It's going to come down to your appliances. There's furnaces that are in there 25 years, and there's furnaces that are in there 2 years. And this person was made by that, and this one was made by that. And so there is an element where you can take that data, come back and come up with a statistical cost of that particular one asset over 5 to 10 years, frequency of failure, cost of failure, and you can just model it with all those other assets in the home.
Interesting.
And then as long as you've got enough homes in that to underwrite that risk and not have the insurance to lose money, I don't think it's very far off.
Because it gets to like, you've got to categorize basically everything in the home. And so you're just basically thinking like, the Matterport in there, but I'm thinking like, how do you statistically model like when a sewer line is going to fail? How do I know like what is clay, what has already been replaced with PVC? Like, so then there probably becomes like tiering
Age of home.
Yeah, and you might.
But I guess you're right. Like it could have been PVC.
That's part of that's part of the challenge with insuring some of these things.
Yeah.
But then there's probably tiers, which is kind of your basic systems and appliances, and then this, and then the most tough thing would be the electrical and the plumbing and the structure of those.
And the whole thing is just like you were saying earlier. If your annual maintenance spend is $2,400 a year, you're not replacing anything meaningful. Like most people are prepared for that. And so again, you're going to have insurance to cover the catastrophics, which again are relatively like well-known and documented. And so really what the hard part is guessing R&M accurately, like within that home. It's actually the $2,400 that a year that you're like, how much are this home going to take versus that home versus that home? And a lot of it's just going to be based off of most likely appliance data for the most part. I do wonder how much age of home plays into it though.
Yeah.
Or will.
My gut tells me age of home is a big lead indicator in repair and maintenance.
You think so?
Yeah.
Well, the hard part is age of home, but like where are they in the renovation cycle? Because right now, like a 1990s home that has not been updated is going to have, I mean, that might be a $70,000 kind of renovation versus a 1950s that's been remodeled in the last, obviously like there's just, those are factors that would make it tough.
The other interesting hair that the only thing that makes me go, ugh, which is really interesting, is how much of maintenance is related to the resident.
Yeah.
Like, that's one massive variable that, even as we were doing this resident renewal thing, it's like the difference between correlation and causation. And did it break early because of the resident, or did it break early because it broke early? And then is that resident the one that generates 1 million service issues, or are they generating 1 million service issues because it did broke early?
Yeah.
So that's the only thing. Now, I will tell you, there is data to show there are people that take care of places better, and you can find out over in the turnover cost side, usually. So you can imagine a world like if that ends up being the case, people could walk around with their "I'm the great renter" passport, and I want lower rent and whatever because I am really good at taking care of properties. That's the only variable.
But it's a big variable.
Or maybe they carry the insurance policy with them.
They could, boy. Wow.
We might have to cut that piece out. That may be our next business here.
There you go. That's a great idea. I was thinking about it. It was like, we accept renters based off of obviously credit score and stuff like that, but it's like that's a whole new modeling of, as based on past performance.
Yeah. The truth is, if you could just go to their last 3 landlords and literally make sure that you're talking to their last 3 landlords and know whether they kept the place up and they paid their rent on time, that would just tell you a lot about what's going to happen.
Yeah. There's an investor we know here in Birmingham, and part of his approval process was, let me take there's a lot of Section 8. He said, I'm gonna meet you at your house. And he would go to their house and see kind of like what the current condition was. And he had a really high success rate because he would screen for tenants. You know, he did this all on his own, but would screen for tenants that took care of the property.
Yeah.
And how do you kind of like get that component at scale? It's obviously a challenge, but that's a big variable.
And there is an element that if they do, they absolutely should be able to get a premium discount off of rent because listen, your outlay at the end is going to be less. It's going to be better. Mm-hmm. And it's like, there is an element we should think about this.
Put a pin in that one.
Yeah.
Well, all right, everybody. Ray, that was awesome. Appreciate you coming to Birmingham just to record this podcast episode.
I can't
if for
believe
nothing
it.
else. Really appreciate you coming, Gray. Appreciate you participating in Spencer's stay. And Ray, if people wanted to get in touch with you, what's the best way for them to do that?
Yeah, so there's two things. One, I want to just say for operators who are focused on maintenance, we have a annual maintenance summit, mxsummit.co. It's held in September. It's an amazing event. It's doubled every year. We've got amazing people. We're expecting anywhere between 400 to 600 people this year. Great event, great for executives, coordinator level, director level, and even just we have technicians come as well. There's certifications and other things all along. So that's one. I'm going to promote that. But two is come to our website, propertymeld.com. Check us out, what we do. And if maintenance is of any interest in moving, we're the right people to talk to.
All right, everybody. We'll see you next time.